that note, I will say welcome to the August 24th, 2016 edition of On the Call, a service of Zacks Institutional Services. Now, if you're new to these calls, what this is a live conference call featuring Zacks strategists providing their analysis and insight on the latest issues and trends affecting investors, including, but not limited to, the current issues and trends on the market economy, both globally and here in the U.S. Today, our Chief Equity Strategist, John Blank, and Tim Nyland, Managing Director of Zacks Institutional Services Division, is going to be discussing the global gloom from a couple of different interesting perspectives. I think you'll find it insightful. Each panelist has some different takes on what's going on with this global gloom, and hopefully some insight as to when it's going to lift. And as far as that goes, John, we'll start with you. You know, it's been pretty well documented that there's been this global gloom in the air for at least a couple of years that I've seen. Your insight is going to share when this gloom will lift, right? So let's open with that.
Yeah, Terry, thanks. The genesis of this presentation, for those who are listening, goes back a few weeks to July, and I work with chief investment officers 4 times a year on a quarterly survey for Zacks. And I asked this question of these types of individuals, and these are people who manage hundreds of millions of dollars and 20 years of experience in the global financial markets. These are the players that really matter, that really move markets, move stocks, they move indexes, they move allocations around assets. Very important group. And what I asked them was this question: what will be the returns performance of global indices, meaning not the U.S., mainly non-U.S. stuff? And amazingly, 5 times more of these professionals than not said these markets will underperform. All of them will underperform. So this is something that is either going to make you a lot of money or something you should be worried about. And that's the genesis of this call. Is Tim and I are going to take you through a tour of ZRS and how to time and to measure the potential for this turn in the global markets. To play this turn, to make money on this turn, is going to be a big, big opportunity for somebody, but it's not that easy. You've got to go against all these CIOs, and you've got to make sure you're with them when they change their minds on this type of thing. So let's go to the next slide, and we'll get on the road with this. Here's what I'm talking about. If you notice, from 2010 to now, the orange line is the EFA, which is the international non-U.S. indices, and the blue line is the S&P 500 growth indices. If you look at this, what you're noticing is that there's a 70% difference between the returns that are available in the orange line and the blue line over the last, particularly the last 2 years. You can see from 2014 to 2015, these international markets have gone down while the S&P has gone way, way, way up. So somebody's got this right. Somebody's going to ride the S&P higher and higher and higher, but those valuations we know are way, way high now, or somebody's going to roll into these international markets and make a killing. And people, by the way, the Brazilian indexes are already up 50, 60%. So that's the type of thing I'm talking about. Let's go to the next slide. All right, so what I want to talk about is this question: when will this gloom lift? Because at the end of the day, this is a sentiment thing, not anything other than that. Let's go to the next question. Right, so what I'm going to ask for is the Purchasing Managers Indexes. Now, these get a lot of airtime out there. We get them announced every month. I'm going to take a look at these over a much longer year after year time frame, because I want to show you how we can get a feel for what's really going on in these big areas of the world by looking at the high level. Now, why do purchasing managers manage? Because they're buying stuff. They're buying goods. They're buying manufactured goods and materials. These are the kinds of things that matter for growth, and they're very clairvoyant about forward-looking pictures of what's going on. Let's go to the next slide. So what we've already noticed is that in August the 1st, the market global PMI summary for North America hit a 9-month high. The Asian PMI went to 50. And if you look at where it's strong, beyond China, which is a big positive, we have India, Taiwan, South Korea, and Vietnam helping us go forward, while Japan, Indonesia, and Malaysia are helping us go back. The other thing to note is the European PMI has been growing for 37 successive months. So We've had growth in Europe for 3 years. So how can does this sound gloomy to you? Does it sound gloomy to say a 9-month high in PMIs for North America? That the Asian PMIs led by the monster China are overwhelming the worries in Japan, and Eurozone growth up 37 months in a row? I don't think so. So let's go to the next slide. Okay, so here's the story. Here's what we got to think about. What happened in 2014 that's different than 2016? And if you look at these squiggly lines, what you're going to notice, first of all, is the big blue line at the top is the U.S. And what's interesting about this, and the green line obviously is Europe, and the light blue line is Japan, and that purple line is China. So I want to point out things one on top of the other. U.S. The one thing that happened, we were at 59 PMIs back in 2014 for the U.S., and they have tanked. We all know that's the PMIs went down with the commodity bust and the oil bust. So at the end of the day, the real thing that blew the global gloom up, if you want the answer from the PMIs, is the U.S. And that's a key insight. The U.S. did not go into the tank like it did in 08. As you can see, that's a totally different thing. But it went to very, very low growth. And it's the low growth in the U.S. and the low PMIs in the U.S. during this commodity and business spending collapse that are really of the most likely candidate that killed the world. And we're going to get into why the U.S. killed the world, but that's going to be my thesis. The U.S. killed the world. Now, obviously, other thing to notice here is that we're actually rising now, and the U.S. is coming back. But by the end of the day, that's going to be the clearest picture here is the U.S. killed the world. The Eurozone has been fine this entire time. Japan, obviously, the other concern is Japan, and that's where we're going to get to. The first, go back to the slide again. I want to talk about China. China has gone nowhere. There's been no issues with China. That's the thing to remember about China. China really hasn't been an issue. Next slide. So here's what we've got. Rising, rising, rising across the orders. So the JP Morgan PMIs are showing that it's just fine. We're doing just fine. Let's go to the next slide. Right, and this is what they're saying. All across the board, everything is fine. Let's go to the next slide. Now this is what the worry is that this turn that we're looking at is very, very weak yet right now. At 50.5, as you can see from back at 14, we were at 52.5 when we added all these up. Now, so we've lost about 5%. I mean, the basic number here is 5% loss in growth. And that's not below 50, but it's lost. Let's go to the next slide. So what I want to do is I want to talk about the world and make some sense out of the world. And what I'm going to do, first of all, is throw this world out number of $74 trillion in GDP. 2/3 of that's in North America and Asia, 20% is in Europe, and 6% in the rest of the world. So let's go to the next slide. Now this is the other thing to notice is back in 2014, if you think of the pound, the peso, the dollar, Canadian dollar, the rupee, if you notice, one of the things that's going on is strong dollar everywhere. Everywhere, strong dollar. What that means is money is flowing into the U.S. It's flowing into the U.S. bonds, it's flowing into the U.S. currency, and it's flowing into the U.S. stock market. So that's taking up that S&P. That's taking down the bond rate. But at the end of the day, this thing is going to have to unwind, and you can see it. It's been going on now for 5-6 years, and it's winding up, and certainly the last 2, and this is a part of the issue we got to deal with. Go to the next slide. So what I want to point out, first of all, is this idea of a sun and solar system, that in global regions, to make sense of these regions and get beyond the rhetoric that's out there that's too vague, is think about a sun and a solar system. In North America, the U.S. GDP sun is 80% of North America. In Asia, China is 50% of Asia. But in the other parts of the world, Brazil, only 1/3 of Latin America, and in the European Union, Germany, is only 1/4. So one of the strengths of the global system now is it's becoming North American and Asian, and these two big areas that drive most of the growth have big suns. And these are different solar systems than the rest of the world. This is the new global system. Let's go to the next one. And let's skip this one and go to the next one. All right, this is what I really want to focus on. So what you're noticing here, the green line is the U.S., the blue line above it, below it is China, and then you've got Japan, Germany, and the U.K. So what you need to notice here is that far and away, if you want to think about what's going on in the global scene, the U.S. matters way more than anybody, and China matters next, and then the difference between China at almost 12 trillion and Japan at 4, that's 1/3, that's a big drop. So when you think globally, the bottom line with global Gloom is it has to live in the U.S. and then it has to be China, and that's what we got to deal with. Let's go to the next slide. So that's my point. This is the story. We've got to focus on the U.S. first, China, and then Europe. Let's go to the next slide. Now, U.S., let's take a look at the U.S. I'm going to focus on payrolls, and this is why I'm going to focus on payrolls. You can read this later. Let's go to the next slide. This is what we want to look at. So the U.S., obviously, there's no problem right now. The growth trajectory in these payrolls is really nice, and there's no issues. And the other thing I'd point out is the unemployment rate back in 07 was even lower than it is now, and it went sideways for a good year and a half before we entered recession. So my thinking is, and I think Tim's with me, is that we're going to go down from 4.9 to 4 before we see the bottom in this unemployment rate, and this thing has another bunch of time to go. And at this low growth rate for the United States, we're getting some stability. This is what you'd like to see without monetary policy changing at this late in the stage and cycle. Low growth is taking us down and decelerating that growth nicely to keep the payrolls keeping going down. I think there's another year, year and a half of this to go on. Let's go to the next slide. This is what we're seeing. That's the stability I'm talking about. If you look at year-on-year change and growth, I don't see anything but stability out of the U.S. But look, you can see from 2014 to 2016 that deceleration, and that's the deceleration that's taken the world down. It's the U.S. that's done it, and that's what we got to talk about. Let's go to the next slide. All right, so that's my point. The U.S. matters most, and let's go to the next slide. The U.S. again, GDP and payrolls. Notice the same thing. We're pointing out, you look at one thing, you look at the other thing. Do you see a downturn? I don't see it. Do you see stability? I see it. And that's my point with the U.S. It's that deceleration at the end here in that GDP that we're going to talk about, because if it's going to track payroll, it's going to keep going up, and it's going to rebalance and get moving forward. Let's go to the next slide. Let's go to the next slide. All right, on to China. This one thing I want to talk about with China is the Caixin indexes. These are new indexes for smaller companies, and these we can get through the underlying individual indexes. But the key point I want to make as an economist that if you want to know what drives stocks in these PMIs, it's the third. Employment growth is what drives stock prices higher. So we need to see employment growth come with the PMI turn to really get it going. Let's go to the next slide. Next slide. And that's what I want to show you. The PMI in China has turned, but it's 50.5. It's very weak, and it's not turned in employment. So the bottom line with China is we got the turn in China, but we haven't seen the employment pick up, and that's what we need to go forward. Let's go to the next slide. And this is what's going on. The Chinese are putting in that spending, fiscal spending. That's what's doing it. Let's go to the next slide. And that's China. There's, like I said, nothing's going on, nothing to worry about. China is just flat, flat, flat. There's been nothing to talk about in 5 years. Next slide. Okay, on to the next slide. Japan, nothing to talk about in 5 years. Other than that latest thing here we notice is that Japan is tanking down. That's one of the issues, but if you look at it over a long period of time, nothing's going on in Japan. Japan's not the issue. Next slide. This is an interesting one. The key point I want to make here, what I hand off to Tim right now, is one of the two things that's happening is the Eurozone is in its second exit from a second crisis. This is a very different picture than we've had with China and the U.S. and Japan. We have a situation here with 2013, when U.S. stock prices were rising, Eurozone growth tanked, and this growth recovered, but it recovered at a much lower level than it's ever been. And this is the key thing to understand. From a stock market perspective, the Europe crisis and the Europe bull market, the second one, is only 3 years old. And the European crisis is what's driving the growth of the U.S. now, and the stock market reflation is low rates in Europe to try to get that growth up the hill. And the other thing is the oil rate that's coming out of the Saudis killing us. So if you want to think about what's going on with low growth in the world right now, it's U.S. driven. What's curious about the U.S. driven is it's driven by two external decisions. And before I hand off to Tim right now, I want to make sure you understand that U.S. is key, China has turned, the U.S. is the key weakness, but the drivers of the weakness in the U.S. are external. The first is Europe, and it's going to keep on pushing on down rates. As you look at that picture, you say, where are rates going? They're going to stay low for another year to get that growth rate up the hill. So we can count on lower rates from Europe for a long time. That means housing is going to keep going up in the United States. The other thing I want to point out is that what killed us in 2014 and early 15 was the Saudis who changed direction. It was the regime of the Saudi Arabians more than anything else that took the oil price down. That regime has not changed. I do not think it is the Arab Spring. I do not think it's the Syrian crisis. All I think that happened in Saudi Arabia is the king died. There were new people that ran the Saudi policy. They dumped a lot of oil, and it's an inventory-driven oil market that's killing off business spending in the United States. So the curious thing about the global gloom is it's the U.S. that has to turn, but the causes of the turn are not decision-making and not decisions made by the U.S. They've made it outside it. And that's what I'm going to hand off to Tim, is this very basic idea of how to look at the world and how to think through these crises and to realize that we've got two situations, a very overvalued stock market given us from Europe and a very weak growth rate that's been given to us by CapEx falling apart because of the Saudis. And with that, I'm going to hand this over to Tim and let him take you the rest of the way.
I'm going to short stop you there for a minute, John. John, I just want to clarify something. You mentioned a lot of different economic indicators. Is there one that you use as the main barometer of global economic health, or do they all come together in different ways?
Well, I think at the end of the day, Terry, we've got to take all these together. We've got to take the U.S. payroll number as the key measure, and if we get stronger payrolls and better unemployment rate, that's going to take the world system up. But at the end of the day, you know, oil prices getting stronger, you know, GDP growth led by business investment, and the PMI numbers all turning up. At least some part of the world turning up above 55 is what we've got to have to get the gloom off the table. Because if you look back, well, what happened was at least one part of the world, us, was doing 55 and 56 PMIs month after month. That's the kind of thing we got to see.
Okay, Tim, let's bring you in here now. With John's global themes as the backdrop, you're going to take a little bit more of a domestic view, I understand. You have two things to make folks aware of that we don't really hear discussed all that often, which could actually drive our U.S. market higher going forward. Is that correct?
Absolutely, and thank you, Terry and John. Yes, that is definitely the case. So what I try to do, and you can kind of roll back one slide because I want to just make a few comments. What I try to do is I try to really focus on analytical issues of relevance that you don't hear about in the press, or maybe you're only getting part of the story. So just as a segue into what I'm going to speak about, you know, we've all heard about the massive debt loads on corporate balance sheets. And, you know, when I sit here at my desk and I hear about this, be it in strategy sessions, be it on CNBC, or I read about it in the Wall Street Journal, you know, more often than not, it's improperly framed. We're not getting the full context. So, you know, what I'm going to show here in a few minutes is how we can use ZRS to actually get a full picture as to exactly what's going on and how this can actually lead to some really positive developments if we look at the trends. The other thing that I hear every day, and this is something that, you know, John and I talk about at length, is, you know, the near record, you know, unemployment levels. And I think we all really need to sit back and consider what a 4% unemployment rate is going to look like in a year. And how that really could push corporations to get off the sidelines, and how it could really spur CapEx and reinvestment in the next year. And I've got some great slides for us to go through and look at this. So you can move on to the next slide. To get started, what we're going to do is we're actually going to use the ZRS composite facility, and we're going to look at the equal weighted Russell 1000. And we're going to take a look at basically two implications for the next leg up in the U.S. economy, as Terry alluded to. So the first thing we're going to look at is basically long-term debt, and we're going to do it relative to total assets, right? And we're going to determine, you know, has value been created? So we'll get to the slide that's on the screen here in a minute. The next thing we're going to talk about is obviously the economic implications for that possible 4% unemployment rate that we could see in a year's time. So what we're looking at on the screen right now is basically a 15-year chart of that Russell 1000 composite equal weighted. Up in the top panel, we've got total assets. And the thing that I want you to notice about that is it's obviously since 2000s, total assets have more or less steadily increased. Long-term debt on the bottom, you can see from basically 07 to 2013, it's essentially flat. From 2000 forward, it's a really sharp increase. Taking us back up to the top panel very briefly, you can see that we did have a mild asset valuation decline in 07, 08, and then if you take a really close look at that long-term debt chart, you can see that we did have a period of deleveraging in 09 and 10, and we all lived through that era, and we know what happened. The key here in looking as to whether value has been created is to look at balance sheet growth in terms of total assets. In other words, have total assets been able to outpace the rise in long-term debt? And I think this is the picture that you really need to look at, and I think this is what the media really misses half the time. Let's move to the next slide. So in order to look at this, we've got to look at this ratio of total debt to total asset levels over time. And I want everybody to just acknowledge and note that spike in Q1 of 09, as we saw in the prior slide, was driven by that 07, 08 asset decline, while total debt levels reached cyclical highs in 09, right? So this was essentially the peak of value destruction in terms of total debt to total assets. And again, we all lived through that. That was the Great Recession era. What I want to do now is I want to focus on that period of 09 to current, because we've seen another full cycle play out, and I think this is the real story. So go ahead and go to the next slide. Okay. So basically from 09 to essentially the first quarter of 2013, we can see that asset growth outpaced total debt growth. So essentially value was created here, and if you recall that first slide that I brought up, it was because essentially we experienced a deleveraging period, the fact that long-term debt for the equal weighted average Russell 1000 company had essentially been flat for that entire time period while asset valuations continued to rise. So this is value obviously being created. If we go to the next slide, you'll see the opposite is true for 2013 and beyond. And these are just very basic cases if you think about it. In this case, total debt growth actually outpaced asset growth. Value in relative terms here would essentially be lost. The real key and where I'm going here is the next slide. And again, we're using interactive charts and ZRS to do this. We can basically overlay the commodity price index. And what I've done here is I've actually transformed that series to a 1-year % change. And I want you to note the inverse correlation, right? As commodity prices rise modestly, we get asset appreciation and values likely to be created in terms of total debt to total assets. The interesting thing is that if you look at this trend, right, we have underway a commodity price rebound. And I expect this trend to continue into 2017 and 2018. And basically expect this trend in total debt to total assets to begin reversing itself. So we're going to go back into another value creation cycle, just like we did out of 09 to 13. Go ahead and go to the next slide. And I want you to keep in mind that even as we've destroyed a little bit of value in terms of debt to total assets from that 2013 period to current, I want you to notice that the cash position, the green line, has continued to basically increase. This is going to be very important as we move on to the next set of slides, so just keep that in mind. Okay, so a few of you are probably saying, okay, this is great, so what? I'm going to tie this all together for you here in just a few moments. So the idea here is what domestically could very well drive the U.S. markets to the next leg up, right? We've already talked about the commodity price rebound, but we can couple that with, if you want to go to the next slide, and all I'm going to do here is I'm going to put the headline unemployment rate, which is the U3, up on the screen. And I want everybody to see that if we continue to add jobs at that July non-farm payroll rate of 250,000 or more, we will see an unemployment rate fall to 4% in 1 year. And the key here is that we've seen this before in other cycles. The ordinary to see this. Go ahead and go to the next slide. Again, similar to a slide that that John Blank showed earlier, the correlation between equity value or equity pricing and non-farm payrolls, it can't be denied. In this case, I'm looking at the Russell 1000 index price relative to non-farm payrolls in green. No significance in using the Russell 1000. I just decided to change it up for this presentation. Normally I do the S&P 500, but for anybody that's a Russell fan out there, I figured I'd do it a little different this time. So everything that we're looking at is more or less due to the Russell 1000 again, and this is the only area where I actually look at index pricing. The rest of all of the Russell metrics that we're utilizing in the slides are done in the ZRS composite facility, and it's representative of that equal weighted average. So what we're going to do now, don't change this slide, what we're going to do is we are going to look at non-farm payrolls essentially over the prior 10 years. So we're going to just take the most recent 10 years of this slide, and then we're going to do my favorite thing to do. We're going to transform that series to a 1-year % change. So we're going to take that green line, cut it to 10 years, and transform it from an absolute number of payrolls to a 1-year % change. And let's go ahead and do that now, Terry. Okay. And what you're going to see, obviously, is that huge trough in 2009. The other thing I want you to pay attention to is that really, really critical time period there at the end of 2014 where we did have another inflection point. Next slide, I actually circle the inflection points for you. These are the really key areas that we need to keep our eye on. And again, using interactive charts, now what I want to do is I want to overlay CapEx divided by total assets onto that non-farm payroll change 1 year. So go ahead and go to the next slide. And what I want everyone to see is that we have what appears to be a very, very strong 4-quarter leading indicator of capital expenditures to come. And this is very important from inflection point perspective because these trends signal a shift in essentially demand, or in this case it's going to be a shift in what we perceive to be CapEx to the extent we can continue this level of non-farm payroll growth. So that last payroll number that we had was very encouraging. So what we can do in interactive chart is we can actually run a regression analysis, and there is a little beta coefficients icon in the upper left-hand corner of your interactive chart that will allow you to do this. If you have multiple series, you can choose any of your variables to be dependent versus independent variables and run whatever regressions you like. So I've done this on the next slide. And you can see that, in fact, one of the enhancements that we've done is we've actually added an optimal lead. So it automatically calculates the optimal lead, and then you can manually lead or lag your independent variable any way you want. But the optimal lead, as calculated by the regression, is 4 quarters. It's got an R-squared of 0.87. That's huge, huge statistical significance. And it's correlated at 0.93. The conclusion here is obviously if payrolls continue to grow at current rates, we're going to see an inflection again, and we'll likely see a demand-driven shift in CapEx by July of 2017 to commensurate with that 4% unemployment rate. So again, this trend that we're seeing in debt to assets on the rise in 2013 is likely to reverse. This is going to be a result of obviously the continued gains in commodity prices and balance sheets getting stronger. Keep in mind that we've got real strength in balance sheets in terms of cash sitting on the sidelines, and any sustained non-farm payrolls in excess of 235 monthly is going to trigger that demand shift in CapEx and give the economy and the market another catalyst for growth. I hope you guys found that informative, maybe a little bit different take on just everybody sitting around the table saying, yeah, debt's a problem, yeah, job strength is great, and that means it's good for jobs. Hopefully we've been able to give you a little bit more empirical evidence as to why this might actually be a really good thing for the economy. And that's all I had, Terry.
Well, Tim, I just wanted to get you to help put some perspective to everything that you've just offered us here. Because whenever you have a lot of charts like this and people are watching charts go by, they're their screen. It's like the weatherman on television. After the charts go by, you say, well, what's the weather going to be? So
absolutely.
To tie it all up as far as the U.S. stock market is concerned, I'm assuming that all of this is going to translate into more opportunity for investors when the gloom lifts?
It is. It absolutely is. So, you know, we've been in kind of this period of lull. We've seen, you know, corporate debt levels ramp up, and debt levels outpace asset valuations. So relatively speaking, that's what we call value destruction on the balance sheet. All the while, cash positions still really strong. They've been steady for the last 10 years. If you look at a common size balance sheet of the equal weighted Russell 1000, we sit anywhere between 16 to 17% cash on average for the equal weighted Russell 1000 stock. That is holding, and cash piles just continue to build. So all it's going to take, you know, think about it as dry pine needles. We've got more and more cash just sitting on the sideline waiting for a catalyst. You know, if multinational corporations and U.S. corporations aren't going to open up their wallet and reinvest, certainly some of this demand from unemployment levels reaching 4%, as shown here in the regression analysis, could certainly trigger a CapEx turnaround, especially, you know, also given the rebound in commodity prices. That's going to be a huge catalyst as well.
Okay, and with that cash on the sidelines, do you see our U.S. market maybe enjoying a Goldilocks scenario going forward?
Yeah, I don't know if I'd call it Goldilocks, right? Because we've always got a lot of headwinds globally. I do see equity risk premium continuing to decline, so I still think that we continue to climb against that wall of worry. What I would say, instead of a Goldilocks scenario, I would say that we have a good, conducive environment for growth, be it slow growth, but growth nonetheless. And we saw that with all of those PMI numbers that John showed earlier. So anything in excess of a 50 on any PMI metric is expansion. And I don't care if it's 50.5 or 53, growth is growth. And when you couple that with a commodity price rebound, and you couple that with unemployment continuing to fall to potentially a 4% level, you're going to get strong correlation in equity valuation on the positive side. So I don't know as though it's necessarily Goldilocks, like I said, but certainly, you know, it's not necessarily the doom and gloom scenario that a lot of people think it might be.
All right, well, thank you for that. As always, we're bumping up against the clock here, so unfortunately, that's all the time we have for today. Thanks to John Blank and Tim Nyland for participating, helping to add some backstory and maybe some perspective and context for you in this situation going forward. If you have any questions beyond this point regarding our services here at Zacks, feel free to email them to zrs@zacks.com. That's zrs@zacks.com. Likewise, if you'd like to receive copies of John's quarterly strategy report or a copy of Tim's PowerPoint presentation featured in today's call, maybe even John's PowerPoint presentation, same email applies, zrs@zacks.com. Or just contact your ZRS representative directly. In the meantime, thank you again for joining us. Hopefully you walk away with some more information that you can find useful. And as always, we look forward to the next time we're all on the call.